Good morning. Welcome to The Open on BNN Bloomberg. I'm Amber Canmar. One of the top things that we're focused on right now is the price of oil, gaining on optimism that COVID restrictions could be easing a little bit further in China. On top of that, you had the OPEC Plus members meeting yesterday. They agreed to stay the course on keeping output pulled back, as they agreed to in October, by 2 million barrels per day. Then you also have G7 nations, the European Union, Australia, signing on to a $60 price cap on Russian oil prices. That comes into effect today. So a lot of dynamics here driving oil prices today, but also broadly. And you can see that really since the summer, oil has been in a little bit of a slump. Let's talk about all of this with a man who lives and breathes this stuff. It's Ed Morse, the global head of commodity strategy at Citi. Ed, thank you so much for being with us. There's all sorts of catalysts that we can pick apart. Maybe we'll start with China and just how meaningful that is to oil prices going forward. How are you thinking about it?
So we think about China in a particularly strong way when we think about commodities in general. China is still the largest commodity importing country in the world. They've been in lockdown mode. Their imports have slacked. The result has been kind of volatility in the metals markets as much as in the oil markets, not knowing what's going to happen. People got optimistic about China a couple of weeks ago. Here's another set of reasons right now with the easing of the lockdown. We actually don't think there's going to be a tangible impact on commodity demand in China until we get to the second quarter. So we think maybe a little bit of this is overly optimistic in combination with the other factors that you were talking about, including the price cap and including the embargo that went into effect today on practically all of seaborne exports of crude oil from Russia to the European Union. And finally, I would note, until you talked about this good news, people were thinking about the Fed being more bearish. We saw the dollar go into a significant sell-off. It's reversed its course today, but that dollar price drop has also been supportive of prices. So as the dollar goes up again, we think there'll be some coming off of the price, depending on what actually happens to Russian exports, which I'd say from the supply side is the biggest unknown at the moment.
Okay, so we're going to unpack all of this. I just want to spend another beat on China because, as you mentioned, it's something that you follow closely across the commodity complex. Has China become more difficult for you to read and interpret in terms of the direction that they're heading? We keep hearing that, the story of China's expansion and opening up and development, since COVID has become less clear cut. Do you feel that way?
Well, we think that there's a lot of noise there. There's no doubt that Chinese underlying oil demand is peaking. The question is, what does the noise tell us about that peaking? In a way, diesel demand reached its peak in around 2010, 2011. It went up a little bit since then. The peak was in 2015. There was a recovery after that. There was also another really strong change in demand for diesel in China, while overall demand is going down. And that is, they have a lot of natural gas-fired trucks, and they have a lot of diesel trucks. And the one really unusual factor in the world market over the last year has been that diesel prices, while going up, are not going up on a BTU basis to the degree that natural gas has gone up. So we've seen, while China was in lockdown, an absolutely extraordinary increase in diesel demand as diesel trucks started taking over from natural gas-fired trucks, CNG and LNG. And now that we have prices coming off on the gas side in China, we're seeing a switching back. So when China had its initial phase of doing something about prices in September of 21, they cut off exports. And among those exports were over 1 million barrels a day of product exports, including 600,000 to 700,000 barrels a day of diesel. And they use that, instead of selling it abroad, using it at home. The diesel markets got tight around the world. We had about 1 million barrels a day of fuel switching into diesel from natural gas, not including what happened in China. And there were some months that Chinese extra demand was as high as 900,000 barrels a day higher for diesel, still not hitting the 2015 peak, but it's noisy what China is doing. And it's not just true on the oil market side, it's true on the gas side. And on top of that, we have China trying to get back to a very significant amount of spare inventories. They want to build up their inventories because they like to keep volatility of prices down. So what they do is they sell off their inventories when prices are high and they buy when prices are low. They've been using this moment to buy more oil for adding to the inventories as well. So yeah, very hard to separate all these moving parts in China, the world's largest importer of crude.
Well, it's in China, but in Russia as well, and maybe we can spend a minute there because part of the goal of this price cap is to, on one hand, punish Russia, but on the other hand, not shock the global supply system and still incentivize Russia to supply the global market, though Russia has said we will not sell to any country that has the price cap. Do you think they're actually going to follow through on that?
I think they will, and I think they've actually done things to enable them to do that. So this is something we've been talking about, they've been talking about since September. They recognized that when they had taken action on the gas side in retaliation for what Europe was doing, their gas exports slumped and their income from gas slump. So we think that they don't really want that to happen on the oil side. The first round of this shunning of Russian oil took place in the spring. Oil exports were down about close to 1 million barrels a day at one stage. Price went up and they didn't lose money, but right now they don't want to lose that volume. So we've seen a significant amount of new availability of tankers. We've seen new trading houses emerging. We think that there are enough tankers to take that Russian oil to countries that are not abiding by the price cap. We think that the insurance mechanisms that people have been worrying about are finding some replaced insurance. And we think that the hit on Russian crude is probably going to be no more than 400,000 or 500,000 barrels a day between now and next month, much less than the close to 1 million barrels a day with the first round of the embargo in the spring. And we think they'll be rebounding back by February and March. So we think the supply will be there. There's a way to find it in getting into the market.
So if you think that, then how does this affect oil prices going forward? What is your outlook when you put all these pieces together?
When we put the pieces together, we're looking at next year in which we see 1.7 million barrels a day of oil demand growth, and we're looking at 2.8 million barrels a day of incremental supply. Now, that includes Russia going down and coming up. It includes OPEC countries keeping to their schedule of keeping oil off the market for the year. So, you know, we don't know exactly what's going to happen. We don't know what's going to happen with what we call the Fragile Five, namely Iran, Iraq, Libya, Nigeria, and Venezuela. Venezuelan oil production seems to be coming up, but the others are kind of iffy. We think Iraq will go up. We don't know what's going to happen with Libya and Iran. But meanwhile, we have very big baseload growth next year from North America and South America. We have between the U.S., where we expect 600,000 barrels a day of crude oil demand supply and another 400,000 barrels a day of natural gas liquids. Between Canada and Brazil, we're looking at between 400,000 and 500,000 barrels a day of supply growth, another 200,000 barrels a day coming out of Guyana, perhaps 100,000 each in Venezuela and Mexico, not to speak of more oil coming out of Argentina. So the Western Hemisphere alone can probably satisfy most of the demand growth coming into next year. We think that the price will be pretty strong in the first quarter when we see an inventory draw, but we see inventories building for the rest of the year, even with OPEC keeping their cut through the second half.
I just want to make sure I'm clear. You're talking about a lot of supply coming at a time where we're perhaps nervous about the demand picture for 2023. Sounds like you're saying the risks are to the downside here.
We actually think that way. We've got, a recovery in China, but we don't think that it's going to be that strong at the beginning of the year. We think over time, it may be 700,000 barrels a day of the demand growth we're seeing in the world as a whole. But with Europe in recession, the U.S. going into a recession, negative demand growth right now in Europe, no demand growth in the U.S. Where elsewhere in the world, other than the advanced economies, that we're going to see significant enough demand growth to build up that demand part of the equation.
Can I pin you down on a price then in terms of where you see that downside?
We see the downside into the mid to low 70s, yes, by the end of the year.
All right, so